For decades, investors lived by a simple, almost unbreakable rule. When the stock market went down, gold went up. It was the financial world's ultimate insurance policy, a safe haven in times of fear, crisis, and uncertainty. But in 2024, that fundamental rule wasn't just bent, it was shattered. We are now living through a moment that has almost never happened in modern financial history. The S&P 500 is hitting all-time highs, the tech-heavy Nasdaq is soaring to record heights, and at the exact same time, gold is smashing through its own price ceilings, surging past levels that analysts once thought were years away. Stocks and gold, two assets that are supposed to move in opposite directions, are now locked in a synchronized, gravity-defying rally. This isn't supposed to happen. It defies decades of economic theory and investor behavior. So, is the financial system finally broken? Or is this a signal of something much bigger? A deep and fundamental repricing of money itself? The answer is far more shocking than you think, and it reveals hidden forces that are quietly reshaping our world. The real story behind gold's explosive rally doesn't begin on Wall Street or with everyday investors. It begins inside the guarded vaults of the world's most powerful governments. The primary force driving this market isn't who you think. It's a silent but massive wave of buying from central banks, particularly from emerging market giants like China, India, Poland, and Turkey. For 2 consecutive years, these institutions have been buying gold at a pace not seen in modern history, quietly accumulating hundreds of tons of the yellow metal. But why now? The answer lies in a single event that acted as a financial earthquake, sending a chilling message across the globe. In 2022, following the conflict in Ukraine, the G7 nations took an unprecedented step. They froze Russia's US dollar reserves. For the first time, a major world power's foreign currency holdings were rendered useless with the stroke of a political pen. This was the shot heard round the financial world. It told every country on Earth that their US dollar assets, the bedrock of the global financial system for 50 years, were not truly theirs. They were conditional, subject to the political whims of the West. This single act triggered a global scramble for a neutral, non-political store of value, an asset that no single government could freeze or devalue. And in that desperate search, there was only one real answer: gold. This isn't just a trade, it's the de-dollarization of the world happening in real time. A quiet rebellion against a system that was once thought to be infallible. But while governments were buying gold by the truckload, a strange mystery was unfolding on the trading floors of New York and London. Before I continue, I'm Adam Invests, and I spend a lot of time breaking down money, compounding, and why so many people get stuck in the paycheck-to-paycheck trap. If you're serious about learning how wealth is actually built, not just wishing for it, make sure to hit subscribe and tap the like button if this video gives you value. While governments were engaged in a historic buying spree, a puzzling thing was happening on Wall Street. The so-called smart money, the massive hedge funds, sophisticated financial institutions, and professional speculators who usually drive these rallies, were surprisingly absent. Market data revealed a shocking lack of participation from these key players. Futures market positioning, a key gauge of speculative interest, wasn't showing the usual hype or extreme bullishness. Other advanced metrics, like the options market's risk reversal, remained unusually weak. In past gold rallies, these indicators would be flashing red-hot, signaling a frenzy of institutional buying. This time, they were lukewarm at best. The big money, the players who are supposed to be ahead of the curve, were sitting on the sidelines, watching. Yet, at the complete opposite end of the spectrum, Main Street was going all in. Reports began to surface of Costco selling out of 1-ounce gold bars almost as soon as they were listed online. In Japan, a major refiner had to completely halt sales of small gold bars, the kind favored by retail investors, simply because they couldn't keep up with the overwhelming demand. This created a bizarre picture. A market being aggressively pushed higher by the largest players in the world, the central banks, and the smallest players, the individual retail buyers. The professionals in the middle, who make their living trading these moves, were strangely quiet. It's a rally built on a foundation of government fear and public enthusiasm, but without the blessing of Wall Street. This puzzle leads to a critical question. What do those quiet professionals know that the rest of the market doesn't? And their hesitation might be rooted in the ghost of crashes past. History serves as a chilling warning for anyone who believes gold only goes up. The metal has a dark and brutal history of catastrophic collapses that have wiped out fortunes. Anyone betting on gold today must reckon with these precedents, because the same forces that caused them could easily return. The most infamous example came in the early 1980s. Inflation was raging out of control in the US, and gold had soared to what seemed like unstoppable new highs. Then, a new Federal Reserve chairman named Paul Volcker did the unthinkable. He raised interest rates to an eye-watering 20%. Suddenly, boring, safe government bonds were yielding more than a high-risk stock. For investors, the choice was simple. Why hold gold, an asset that pays you nothing, when you can get a guaranteed double-digit return from the US government? Money flooded out of gold and into bonds, and the price of the precious metal collapsed by over 50%, entering a painful bear market that would last for 2 decades. More recently, from 2012 to 2017, gold suffered another prolonged downturn. The fears from the 2008 financial crisis had finally faded. The global economy was stabilizing, and the Fed began tapering its money-printing programs. As stability returned, the case for owning a crisis asset like gold evaporated, and its price bled out for years. The triggers that caused these historic crashes are lying dormant today, waiting to be reactivated. There are at least 3 scenarios that could lead to another 20% or even greater collapse in the gold price. First is the possibility of unexpected economic strength. While many are betting on a US economic collapse, what if they are wrong? What if the AI revolution and a new wave of technological innovation fuel a massive productivity boom? In that world, money would rapidly rotate out of assets based on fear, like gold, and into assets based on greed, like high-growth tech stocks. The second trigger is geopolitical stability. A sudden and lasting resolution to the war in Ukraine, or a surprising de-escalation of tensions between the US and China, would remove a key pillar of fear that is currently propping up the gold price. Finally, there's the government's secret weapon. If the US Treasury ever decides that a high gold price has become a direct threat to the dominance of the US dollar, it could choose to intervene. With the largest official gold reserves in the world, the US could begin selling tons of gold onto the open market, creating an artificial flood of supply and engineering a price crash. The risk is real, and it's why some of the smartest minds on Wall Street are remaining cautious, even as prices soar. But what if the dollar price of gold is the wrong thing to be watching altogether? When we see gold hit $2,400 an ounce, our first instinct is to think gold has become extremely expensive. But that number is only half the story. The price of gold in dollars can be misleading. The far more important question is, what can an ounce of gold actually buy you in the real world? This is where the story takes a fascinating and slightly disturbing turn. If you measure gold's purchasing power against low-value everyday goods, it looks stronger than ever. For instance, today, an ounce of gold can buy you significantly more Big Macs or more cups of coffee than it could have 20 or 30 years ago. By this metric, gold seems like a fantastic preserver of wealth. However, when you measure it against high-value, long-lasting assets, the picture flips completely. That same ounce of gold today buys you less of a Ford F-150 pickup truck than it did in the 1970s. And when it comes to prime real estate, the difference is staggering. An ounce of gold today buys you a dramatically smaller fraction of an average property in Manhattan or London than it could have in the past. This creates a shocking paradox. Gold's value has kept up with burgers, but it has failed to keep up with trucks and houses. What this really tells us is not that gold is overpriced, but that the value of our paper money, the US dollar, is collapsing at different speeds against different things. The prices of manufactured goods and real assets are inflating much faster than the official government inflation numbers suggest. We are not living in a gold bubble. We are living in a crisis of confidence in fiat currency. The record high price of gold isn't a sign of its strength. It's a symptom of the dollar's profound weakness. It's a barometer of a system where printed money is losing its claim on real, scarce, and desirable things. And while most investors are debating the price of physical gold, this deep disconnect has created what might be one of the most overlooked investment opportunities in the market right now. While the world is fixated on the soaring price of physical gold, a massive and highly unusual disconnect is happening in a closely related market: the stocks of the companies that mine the gold out of the ground. This is where the story gets really interesting for savvy investors, because it reveals a pocket of the market that may be secretly and historically cheap. Here's the Wall Street miscalculation. As of late 2024, gold is trading well over $2,400 an ounce. But if you look at the financial models of many sell-side analysts at major banks, they are still valuing gold mining companies using long-term price assumptions of $2,200, $2,100, or in some cases, even lower. There is a huge gap between the current reality of the gold price and the conservative assumptions being used to value the companies that produce it. This disconnect is creating an explosion in profitability. One analyst described the profit margins for gold miners right now as the most fantastic he has ever seen in his career. These companies are paying for the cost to mine an ounce of gold and then selling it on the open market for a historically wide profit. They are cash-gushing machines. Yet, their stock prices do not fully reflect this new reality. The market has essentially priced these stocks for a major gold crash. It is assuming that today's high prices are temporary and will soon come falling back to earth. This creates a compelling opportunity. If you believe that the high gold price is not a fluke, that it is driven by the deep structural forces of de-dollarization and currency debasement, then these mining stocks could be profoundly undervalued. If the gold price simply stays where it is, let alone goes higher, these companies will continue to generate enormous profits that far exceed Wall Street's current, timid expectations. It's an asymmetric bet where the market is pricing in a collapse that may never come. With gold smashing records, forecasts that once seemed radical are now entering the mainstream. The idea of gold reaching $10,000 an ounce is no longer a fringe fantasy. It's a serious topic of discussion among seasoned analysts. But what would it actually take to get there? It's not about hype or a speculative mania. A move to that level would be driven by a fundamental breakdown in the current financial order. And there are three primary drivers that could make it a reality. The first is a shift in central bank policy toward inflation acceptance. For years, the Federal Reserve has been on a crusade to get inflation down to its 2% target. But what if, facing political pressure and the risk of a deep recession, they give up? What if they implicitly accept a new normal of 3% or even 4% inflation? In that world, every dollar you save would lose value at an alarming rate, forcing investors and even institutions to seek refuge in the one asset that can't be printed: gold. The second driver is the sovereign debt bomb. Western governments, particularly the United States, are burdened by unprecedented levels of debt, with no realistic plan to ever pay it back. At some point, investors will begin to question the safety of government bonds. If the day comes when investors lose faith in the full faith and credit of the US Treasury, a global panic will ensue. Money will pour out of bonds, the traditional risk-free asset, and search for a new anchor of safety. Gold would be the ultimate beneficiary of such a crisis. Finally, the third driver would be the final break in the dollar-centric system. The de-dollarization trend, currently driven by fear, could accelerate into a formal strategic realignment. A new bloc of global powers, led by nations like China and Russia, could decide to create a new trade settlement system partially backed by gold, officially remonetizing it as a core reserve asset. In a world where gold is repriced against the colossal mountain of global currency and debt, now measured in the hundreds of trillions, a price of $10,000 an ounce doesn't seem crazy. It's just the mathematical result of a broken system finding a new equilibrium. We are at a historic crossroads. The forces pulling the gold market are more powerful and contradictory than ever before. On one side, you have a rally driven by a monumental geopolitical power shift, as nations abandon the dollar in a desperate search for financial sovereignty. On the other, you have the persistent, historical risk of a devastating crash, triggered by a surprisingly resilient US economy or a sudden return to global stability. And beneath it all lies the deeper, more unsettling truth. This isn't just about gold. It's about a deep-seated crisis of confidence in the value of our money and the sustainability of our debt-fueled system. The price of gold is no longer a simple indicator of fear. It has become the battlefield for the future of money, a referendum on decades of fiscal irresponsibility, and a search for truth in a financial world flooded with trillions of printed dollars. The question for every investor is no longer if gold is important, but what its record-breaking price is trying to tell us about the uncertain future that lies ahead.